There's a version of the financial system you were never supposed to see. Not because it's illegal. Everything I'm about to show you is completely legal. But because the moment you understand how the 1% actually protect and grow their money, you can't unsee it. And the people at the top would rather you never looked. Let's look. The wealthy don't hide money the way movies show you. Offshore accounts, Swiss banks, briefcases moving through airports. That's fiction. What they actually do is far more boring, far more legal, and far more effective. They hide it in plain sight. In legal structures, tax codes, financial instruments sitting in public documents that nobody told you to read. Today, we read them. What you're about to see is documented: IRS code sections, SEC filings, estate planning case law, ProPublica's analysis of billionaire tax records. I spent 90 days going through public documents to put this framework together. Not opinion, not theory, architecture, 5 moves, completely legal, available at multiple income levels. Let me show you why the wealthy built these walls and how you can start building yours. In 2021, ProPublica published the largest leak of IRS data in history. What they found stopped people cold. The 25 wealthiest Americans, combined worth over $1 trillion, paid an average true tax rate of 3.4%, not 37%, not 20%, 3.4%, not because they cheated, because they understood something you were never taught. The tax code was not written against the wealthy. It was written with them, by lobbying, by precedent, and by decades of estate planning attorneys who turned legal structures into an art form. The gap between what the wealthy pay and what you pay is not luck. It's not cheating. It's a curriculum. And we're about to go through it, move by move. This is how the 1% actually hide their money. 5 moves. Let's get into it. Move 1. The entity fortress. The wealthy don't hold assets in their personal names, not real estate, not investments, not businesses. They hold assets inside legal entities, LLCs, S-Corp, family limited partnerships, and irrevocable trusts that create a hard legal wall between them and everything they own. The 3-layer structure looks like this. At the top, your personal name. It holds almost nothing. A creditor who sues you finds a nearly empty estate. Below that, a holding company. Below that, an operating entity that takes on the liability of the business. When a wealthy person gets sued, and they do, the attorney finds nothing. Not because there's nothing there, but because nothing is in their name. The house is in a trust. The business is in an LLC. The investments are in a holding company. You can't seize what isn't legally yours to begin with. That's not a loophole. That's architecture. Here's what makes this different from everything else in this video. This is the lowest barrier move on this list. A single-member LLC costs between $50 and $200 to form in most states. This is not a move reserved for the ultra-wealthy. A $30,000 rental property sits behind an LLC as effectively as a $30 million portfolio does. The wealthy use it earlier. They use it more aggressively. That's the only difference. This is a same-week action. A first rental protection structure you can have in place before your next mortgage closes. Move 1 is the foundation. But the entity structure alone doesn't generate the tax-free cash flow. That's move 2. And it's the strategy Bezos and Musk both used. We have the SEC filings to prove it. Move 2. Buy, borrow, die. 3 words that explain how the wealthiest people on earth access hundreds of millions in liquidity without ever triggering a taxable event. The IRS taxes income. Loans are not income. That's the entire mechanism. That's the whole thing. Here's the 3-step mechanism. Step 1. Buy appreciating assets. Stock, real estate, anything that grows over time. Step 2. Instead of selling those assets and triggering a capital gains tax event, borrow against them at low interest rates through a securities-backed line of credit. The loan proceeds are cash in your account and completely non-taxable. Step 3. The asset keeps appreciating while you deploy the borrowed cash. Elon Musk, Larry Ellison, and Jeff Bezos have all used this. It's in their SEC filings. When a billionaire borrows $100 million against stock, they've never sold. They have $100 million in cash, a tax bill of zero, and they never had to give up the asset that keeps compounding. That's not tax evasion. That's the tax code working exactly as designed for the people who designed it. The accessible version of this move is a HELOC, a home equity line of credit. A homeowner with $200,000 in equity can borrow against it at mortgage rates, non-taxable, and deploy into income-producing assets. The principle is identical. The scale is different. Same architecture, different zeros. Buy, borrow, die gets its own full episode in this series. We're barely scratching the surface right now. But move 3 is where most of you are going to feel something shift. Because this one involves a vehicle your financial advisor almost certainly never mentioned. And there's a very specific reason for that. Move 3, the insurance vault. The wealthy use life insurance as a financial instrument, not death protection. And once you understand why, you're going to want to know why nobody told you this sooner. Indexed Universal Life, IUL. And at the ultra-high net worth level, Private Placement Life Insurance, PPLI. What makes these instruments extraordinary isn't the death benefit. It's the triple tax advantage sitting in the tax code. Growth inside a life insurance policy is tax-deferred. Policy loans against the cash value are tax-free, and the death benefit passes to heirs income tax-free. 3 tax advantages in one structure. For the ultra-wealthy, PPLI allows them to hold hedge funds, private equity, and custom investment portfolios inside this insurance wrapper, receiving institutional returns without the tax drag. This vehicle is essentially unknown outside private wealth management circles. Your financial advisor probably never mentioned this, not because it doesn't work. It's in the IRS code. Because the commissions on a properly structured IUL are lower than the commissions on the products they're incentivized to sell you. Let that land for a second. There's a legal tax-advantaged financial instrument, documented in the tax code, that generates less commission revenue for the person advising you. That gap between what's legal and what you get told about, that's where the wealthy live. Your financial advisor probably never mentioned this. Not because it doesn't work. It's in the IRS code. Because the commissions on a properly structured IUL are lower than the commissions on the products they're incentivized to sell you. Let that land for a second. There's a legal, tax-advantaged financial instrument, documented in the tax code, that generates less commission revenue for the person advising you. That gap between what's legal and what you get told about, that's where the wealthy live. The accessible entry point. A properly structured IUL with a reputable carrier is accessible from around $500 to $1,000 per month in premium. The critical qualifier is properly structured, overfunded, not bought as a sales product. That distinction is the practical unlock. This is not a product recommendation, it's a framework. Before acting on any of this, work with a qualified financial professional who has a fiduciary obligation to you. What I'm teaching you is how to ask better questions. Move 4. This is where it gets immediately actionable. Move 4. Real estate depreciation and cost segregation, the most accessible tax shelter in the United States tax code. And this is where I need you to pay close attention, because this move has the highest immediate actionability of everything I'm about to cover. If you own a rental property right now, you can take action this week. Depreciation allows a real estate investor to deduct a portion of a property's value every single year as a paper loss, even while that property appreciates in market value. The property went up $80,000 last year. The government says you lost $15,000. Both of those things are true at the same time. That's not accounting fraud. That's depreciation. And it's the reason wealthy real estate investors pay almost nothing in taxes while their net worth climbs every year. Cost segregation takes this further. Instead of depreciating a property over 27.5 years, an engineer reclassifies components, flooring, fixtures, landscaping, as 5 or 15-year assets. The deductions accelerate. The paper losses arrive early, when your income is high and the offset matters most. A $200,000 rental property generates approximately $7,200 per year in paper depreciation at the standard 27.5-year schedule. That's a real tax deduction on a phantom loss, available on your very first rental property. No special status required. Now add real estate professional status. If a spouse or partner qualifies, 750 hours per year materially participating in real estate, passive losses from real estate become active losses, fully deductible against W-2 income without the passive loss limitation. This is the tax strategy hiding inside dual income households that almost nobody discusses publicly. A cost segregation study on a $500K property typically costs $5,000 to $15,000 to complete. The acceleration in deductions typically returns 5 to 10 times that in tax savings. If this is the only thing you do after watching this video, call a CPA who specializes in cost segregation this week. This one. The first 4 moves are tools. LLCs and trusts protect what you have. Buy borrow die keeps it liquid without a tax event. The insurance vault makes it grow tax-free. Depreciation shelters the income it generates. Move 5 is different. Move 5 isn't about protecting wealth while you're alive. It's about what happens to everything you've built after you're gone. And this is where the 1% separate from everyone else permanently. Move 5. The Dynasty Trust. Most families build wealth in one generation and lose it in the next. Not because they didn't earn enough, because they didn't know this existed. The estate tax currently sits at 40% on estates above $13.61 million per individual. Without planning, a family that builds a $20 million estate over a lifetime writes a $2.5 million check to the IRS. And that's before probate costs, attorney fees, and the years of delays that destroy business continuity. A dynasty trust, established in jurisdictions like South Dakota, Nevada, or Delaware, removes assets from the taxable estate entirely, while still benefiting descendants, sometimes perpetually. Generations of benefit from wealth built once. The Grantor Retained Annuity Trust, the GRAT, takes this further. It allows a wealthy individual to transfer future appreciation of assets to heirs at near-zero gift tax cost. If those assets grow faster than the IRS's assumed hurdle rate, all excess appreciation passes to heirs tax-free. This is the mechanism behind billions in Walton family and Bezos family wealth transfers. It's publicly documented in estate planning journals. The Waltons, the Rockefellers, the families whose names are still on buildings 100 years later. They didn't just earn more. They built structures that the tax code couldn't touch. Those structures are available to anyone who knows to ask for them. 5 moves, not secrets, not loopholes, structures, documented, legal, sitting in public records that no one told you to read. This is why this channel is called Zero to Dynasty, not zero to rich, not zero to comfortable. Dynasty means it outlasts you. It means the work you do now echoes forward into your children's lives and their children's lives, without the estate tax taking half, without probate destroying the timeline, without the structures collapsing the moment you're gone. The fortress isn't built in a day. It's built in the order of the moves. Entity structure first, that's the foundation. Tax-free liquidity second. Tax advantage growth third. Real estate depreciation fourth. And on top of all of it, the Dynasty Trust, the capstone, the structure that converts wealth into something permanent. You now know what most people never learn. Use it.